Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have explained you about inventory management. The meaning of the term inventory. What is inventory management? What are the techniques available for inventory management? What are the objectives of inventory management? All these things I have already explained in the last video. So if you have not watched that video, I suggest you to go to the playlist of my channel. Select the subject financial decision making. Select the topic raising capital. Watch the videos of inventory management. Now this video is the continuation of the last video. Here again, I am going to explain you the different techniques. In examination, very frequently a question, theory question will be asked regarding this inventory management. The first technique for managing the inventory is EOQ, Economic Ordering Quantity. Last video I have explained you the meaning of the term EOQ. The economic ordering quantity is that quantity of material to be ordered at a time so that the ordering cost and the carrying cost are minimum. So for inventory cost, two types of costs are there, ordering cost and carrying cost. So that units, that number of units at which the ordering cost and carrying cost are minimum, that ordering quantity is called economic ordering quantity. Now in this video, I am going to explain you about the assumptions or limitations of that EOQ. Then I am going to explain you about the formula for EOQ. Then how many orders to be placed in a year? What is the frequency or the time gap between two orders? Then I am going to explain you about tabular, determination of EOQ by table form, not by formula. And lastly, I am going to explain you about the stock levels. This is the second technique. First technique is EOQ. Second technique is tabular. Second technique is stock levels. There are different stock levels that I am going to explain. So before starting the video, take the screenshot of the points which I have written on the board. Then I'll explain all the points. Now, first of all, I'm going to explain you about the assumptions of EOQ or limitations of EOQ. So while calculating the EOQ, a number of assumptions have to be followed. What are the assumptions? First of all, total number of units to be consumed during the period is known with certainty. Then only we can apply this EOQ technique if we certainly know how many units we want for consumption during the particular period. For example, in 1 year, how many units is our consumption? Annual consumption should be certain, should be fixed. It should not be uncertain. If it is uncertain, our EOQ calculations will be wrong. So first requirement of EOQ, the total number of units required per annum must be certain. Secondly, the total ordering cost remains constant. So before applying the EOQ technique, how much is the ordering cost we have to find out. What is the cost to place one order? And this should be proportional. That means for one order 50 rupees, two order 100 rupees, three order 150, four orders 200. Like that it should be fixed. Thirdly, the inventory cost remains constant. That means the purchase price of inventory should not change. The same price will be applied throughout the year. The next one, there are no quantity discounts available. Practically what will happen, when we purchase the material in bulk, we will get quantity discount. But here for calculating EOQ, we have to make the assumption there are no quantity discount. Whether we purchase for 1 unit or we purchase 1000 units, same purchase price is applicable, no quantity discount. That is the assumption. Only on the basis of this assumption, we calculate EOQ. The lead time does not fluctuate and the order is received on time. Lead time means the time gap between one order and the next order should be same. That means the time gap should not change from one order to another order. And next thing is the order is received on time. Always we have decided whenever we place the order, we will receive the order within so and so time. If these assumptions are satisfied, then EOQ will be correct. Otherwise, if these conditions are not satisfied, then whatever EOQ we get, that is not reliable. We will not get the complete benefit from EOQ. So in examination, a theory question will be asked, what is EOQ? What are the assumptions? Just now I have explained. Now, calculation of EOQ. What is the formula for calculating economic order quantity? The formula is 2CO by I under root. EOQ stands for economic order quantity, that we have to find out, and C stands for annual consumption or annual usage. How many units we require in 1 year. Then O stands for ordering cost per order. When we place one order, how much is the total ordering cost we require? That is ordering cost, O. I stands for carrying cost for 1 unit per annum. That means if we keep 1 unit in the stores for 1 year, how much cost we have to incur on 1 unit of material? So carrying cost per unit to carry in the godown for 1 year. That is I. That's it. So I have explained you about assumptions and formula. Now, number of orders per year. In the coming problems, we come across to find out the EOQ, to find out number of orders in a year. Formula for calculating number of orders, annual requirement divided by ordering quantity. Every time how many units we are ordering. Example, annual requirement is 1000 units. Annual requirement is 1000 units and the ordering quantity is 100. So 1000 divided by 100, you will get 10 orders. So you will get number of orders are 10. Frequency of orders or number of days between two orders. Next question which may be asked in the coming problems are, what is the frequency of orders or how much is the time gap between one order to another order? Number of days in a year divided by number of orders in a year. These three formulae you have to remember. EOQ and the number of orders in a year and what is the frequency or time gap between two orders. That is one method of calculating EOQ. One more method is there for calculating EOQ, that is called tabular method. Tabular determination of EOQ. In a table we are determining, we are not applying the formula. Without applying the formula, we have to find out EOQ by a tabular form. In table, we draw the columns purchase cost, ordering cost and carrying cost. 3 columns we will make. Then we calculate what is the total of these 3 costs at different levels of orders. When we make 100 units per order, when we make 200 units per order, when we make 400 units per order. In this way, different ordering quantities we have. Now we calculate for different quantities how much is the total inventory cost consisting of purchase cost, ordering cost and carrying cost. That is called tabular form. So tabular form will be more suitable whenever discounts, quantity discounts are given. If no quantity discount is given, easily we can find out the EOQ by formula. If quantity discounts are given, it is better to find out EOQ by tabular form. That's it. Next is stock level. So far I have completed one technique, that is EOQ. Now I am going to start the next technique, that is stock levels. This is another one. One aspect of inventory management is that production should not be adversely affected due to want of material. That means one of the requirement objective of inventory management is production should not be interrupted. Production should not be stopped due to want of material. There is no material at all. That's why machines are remaining idle. Labor is remaining idle because lack of material. This is a situation which will arise due to shortage of material. Non-supply of material. That situation should not arise. Similarly, there should not be an unnecessary blocking of capital funds due to overstocking of material. That means neither there should be excessive material nor there should be shortage. If there is shortage of material, then production will be held up. If there is excessive material, then money will be blocked unnecessary, on which material that cost will be incurred in the form of interest, storage cost, etc. So neither excessive inventory nor shortage inventory. That is the aspect of inventory management. Now, how to attain this objective? This always means there is always a limit to the minimum maximum quantity of stock. That means the management must know what is the minimum stock to be held, what is the maximum stock to be held. For that purpose, the storekeeper, the person in charge of the stores, will make bin card. Bin card is a card which is hanged on the racks where materials are kept. On this bin card, different levels are specified. Maximum level, minimum level, reorder level, average stock level, danger level, safety stock level. These are the different levels which are written on the bin card, and the bin card is hanged on the racks where materials are kept. And it is the responsibility of the storekeeper to check every day what is the level of each type of material, so that the level should not cross the maximum, should not go over maximum. Similarly, the material should not come below minimum. Always there should be between maximum and minimum. So now, in examination, problem will be asked. Calculate the maximum level, minimum level, reorder level. So here I am explaining the formula to calculate maximum level. First of all, reordering level. Reordering level is that level whenever inventory reaches this level, the storekeeper must initiate a purchase order for this material. I am the storekeeper. I will, on a particular day, I will see that one of the material has reached a reorder level. Immediately, I should take a form, purchase order form. I should fill up the details of that material and send this material to the purchase manager. On the basis of this purchase order, the purchase manager will give the order to the supplier. So what is the level of inventory at which a new order should be placed? That is called reorder level. So what is the formula for reorder level? Reorder level is equal to maximum usage into maximum reorder period. Remember the formula. Maximum consumption into maximum reorder period. That will be given in the problem. Or one more formula for reorder level is minimum level plus consumption during lead time. Minimum level plus consumption during lead time. Depending on the information given in the problem, we have to apply any of this formula. That is reorder level. Now, minimum stock level. Minimum stock level is that level below which the inventory should not be allowed to go. For example, in our example, bin card shows that minimum level is 100 units. The storekeeper should always keep a close watch. This inventory should not go below minimum. It should be, the minimum is 100 units, that's all. So before 100 units only the new stock should be replenished. Now, minimum stock level, what is the formula? Reorder level. Already we have calculated reorder level. Minus normal usage into normal reorder period. That is given in the problem. This is minimum stock level. Now, maximum stock level is that level beyond which the inventory should not be allowed to go. If the inventory comes below minimum stock level, there is always a danger that production will be stopped due to lack of material, shortage of material. If the inventory has fallen down below minimum, if the inventory goes over maximum stock level, it means there is overstocking of material. Money is blocked unnecessarily. The profitability will come down. So material should not be allowed to go beyond maximum stock level. So what is the formula for maximum stock level? Reorder level plus reorder quantity minus minimum usage into minimum reorder period. Reorder level plus reorder quantity minus minimum usage into minimum reorder period. This formula will give you maximum stock level. Next is average stock level. The average is between the minimum and maximum. So normally the storekeeper should see that the stock should be around the average. Around the average. Example, average stock level is 500 units. So always every day he has to see it should be around 500, just more than 500 or just below 500. But it should be around average 500. So how to calculate average stock level? Minimum stock level plus half of reorder quantity. The minimum stock level plus half of reorder quantity will give you average stock level. Danger stock level. This danger stock level is below the minimum stock level. Suppose the minimum stock level is 100 units. Sometimes there is delay in receiving the goods from the supplier. So material has further fall down to 50 units. And at 50 units, it is a danger stock level. So whenever inventory reaches danger stock level, emergency steps should be taken by the storekeeper, by the purchase manager to get to the material as soon as possible, because it is emergency situation. If it allows to fall below danger level, always there is a danger of stoppage of production. That's why the inventory should not go below the danger level. So what is the formula for danger stock level? Average rate of usage into emergency delivery time. So what is the emergency delivery time? When we purchase the goods locally, what is the duration? What is the time required, emergency time to get the delivery? So this is the formula for danger stock level. The last one is safety stock inventory. Some organizations will keep some small quantity of inventory for emergency usage, because always there is uncertainty regarding the demand, regarding the production, regarding the supply. Always future is uncertain. To meet that uncertainty, a small quantity of material should be kept aside always, so that this small quantity which is kept aside can be supplied only during emergency period, not during normal period. For example, in a factory, one chemical is used, and this chemical is very much critical, important from production point of view. If there is lack of material, chemical for a single day, it incurs huge loss to the production. That's why management, what they will do, they will keep suppose 2 liters or 5 liters of chemical separately. Always they keep it separate, and this separate material will be issued only during emergency, not during normal time. So here this technique emphasizes on maintaining a small stock of inventory in hand to protect against unexpected market demand, because the demand production is completely uncertain. So to meet the uncertainty, some quantity of metal is kept aside. This technique helps in smooth operation against unanticipated market demand. So this is always kept to protect the business from unanticipated changes in the market demand. And without safety stock inventory, an organization control could experience loss of customers, loss of revenue, and loss of market share. If a business do not keep this safety stock, there are chances that this business may incur loss, business may lose the customers, or business market share will decline. So it is preferable, it is advisable to organization to keep a small stock of inventory aside as safety stock. That's it. So in this video, I have explained you about the assumptions or limitations of EOQ, how to calculate EOQ, tabular EOQ, and the different stock levels. One more video is required for this inventory management regarding the other techniques like ABC technique, JIT technique, VED technique, FSND technique. These techniques I'll explain in the next video.